So we're getting to a chart now with two moving averages plotted. I'm using the very popular 20 period and the 50 period, and I'm using the exponential moving average. Now remember, the difference is the SMA just calculates the average of the last X number of bars, depending on what your look back period is. The EMA, however, is going to front weight the most recent price data, which will make it more reactive when you have price shocks, such as during news releases. But remember, there's nothing magical about the number, and there's nothing magical about the EMA or the SMA. Let's take a look here. We have our 20 and our 50 here, but over here, basically have a 13 and a 53. So if anyone tells you a 50 is a great number to use, well, why not a 53? Why not a 45? If a 20 is so great, what's wrong with an 18? You'll hear things like, well, hedge funds use them. I don't know if they do or not. Who says that? That's just a myth that I think that's been put out there, and you really can't quantify that. If they all use them, who knows if they all use them? Over here, we've got SMAs. Look at the difference on the SMA and the EMA. You can see over here on this price pulls right back up into the 50 period EMA. Over here, price doesn't really come close to it. It comes halfway, roughly, to the 50 SMA. So it's going to depend on what you want from your moving average. Do you want it to be reactive, or would you rather have it gradually accept the new price? That's entirely up to you and what's going to suit your own trading. But like I said, remember, there's nothing magical about them, right? If you look at our numbers, the biggest difference is going to be a shorter look back period is going to have a very sporadic move. So you're not going to see it too much here because we're using a daily chart. But if you go down on lower time frame charts, the more whippier the price is, obviously the more whippier the moving average is going to be. As well, if you use a longer term moving average, and just by using these two, you can see the 50 is further away from price than the 20 is. Put 100 on here, it'll be out here somewhere. So it just depends on how close you want the changes in the moving average to be. And all that's going to have to be determined through your testing as well. And we talked about moving averages, support and resistance, and you hear that a lot. And you watching in the news, or even some of the people on YouTube, they'll say that price found support or price found resistance at its 50 EMA, or it's 50 SMA, or it's bounced off the 100. Well, let's think about that for a second. It's just an average of price. How is that anything other than just a coincidence, perhaps? And how close is close? For example, here, someone would say it bounced off the 20, but did it really bounce off the 20? No, it's miles away. Miles away. Over here, it's all over the place. What you can use that for is when price is getting close to a moving average, right? Why would it get close to a moving average? Because for some reason, price has slowed down, and it's allowed the moving average to catch up. When price is slowing down, what's happening? It's finding a balance. When price speeds up again, it's becoming out of balance, right? From balance to out of balance, back and forth. That's what we look for. So what can you use that for? Well, let's say over here, prices come up to our 50 right away. What are you going to do? Look left. What comes up to the left? Well, let's take a look. Here's our 50. Let's look over to our left. Is there any sort of price structure we could trade against? Well, look at that. Price pulled back, range broke out, comes back to test it. Also, what about this move up here? A to B, C to D, right? The complex pullbacks. Do they match? Well, let's find out. A to B move. If it's and there we go. Exact same measurement, symmetry pullback, right? Into what? Into market support. In a symmetry pullback right into what? Structure resistance in the area of a 50. You could use that as your basis for trading. All right, this is the simple moving average. Let's look over at the exponential moving average. Not going to make much of a difference, is it? It's kind of the same thing. Over here, what do you get? Price breaks above, breaks down. Here's our problem. Remember we talked about trend. Are you using a 50 for trend or are you using a 20 for trend? Well, if you're using a 50 for trend, this is telling you to look for shorts. If you're using a 20, it's starting to angle up here. Price is above it, now it's below it. Kind of whippy action here. Perhaps you stand aside. If you're using a 50, you're still looking for shorts until in this area right here. Then your shorts are off the table. Now you're looking for long trades, right? Again, price comes back close to the moving average, right? But is it really finding support here? Well, let's take a look what we have here. Fed can draw. What do we have here? Price up here, breaks down, breaks up, pullback, continues on its way. You can use the moving averages to get you in tune to the market structure to the left of price. What else do we have? Let's keep on going through this chart a little bit. I'm just going randomly. I'm just stopping wherever. Over here, if you're looking at trend determination, you still have an uptrend here. It gets violated here, right? Getting price acceptance below it. These ones just pivoted off of it. And now where are you going to trade? Price is below the 50, price is below the 20. Looking for short trades. Looking for short trades, you get taken out pretty quickly, right? Let's look back up in here. Now we got our trending move. We get pricing moving away from a moving average. When it's moving away from a moving average, we like that, right? Because now price is on the move. When it's going sideways like this, not very conducive. Now we got pullbacks. But again, what's price pulling back into? Well, look left, right? It's not support and resistance, right? This whole area and through here, bang, bang, bang. Same thing, right? Price rallies up, pulls back down into where? These areas right here. Some people will say, well, that didn't come close, right? But people will call these violations acceptable. It doesn't have to be bang on, right? They're called zones. Over here, price breaks up. Look what's happened. Price is going sideways. Look what's happening. The moving average is catching up to price. That's just a function of the calculations, right? Same thing. Over and over and over again. So what we could use this for, we could use it, okay, we're going to trade long or short. If we're going to trade long or short, what are we using? 20 or 50? Are we using an EMA or are we using an SMA? Are we using price just above, price below, or do we need the slope in line as well? When it comes to pullbacks, what do we need? Price to pull back to 20, price to pull back to the 50? Well, if it does that, then what do we look for? These are all part of your trade plan that you're going to have to put together. You can't just put these on your chart and say, okay, I'm going to take every single pullback. You can't do that because like this one bounced off of here, right? Well, here it didn't, but then price continues on the upside, onto the upside, into the upside. You can't just take every pullback. Yes, it pulls back here, it bounces off here, but look what's happened. Price has been ranging. So obviously it's going to catch up. But some traders say, okay, well, it's bouncing off the 20. I'm going to take that trade. So they take that trade. Doesn't support at the 20, doesn't support at the 50, but it comes down in here and it goes back up. Your trade plan is going to have to account for all of that. One of the better ways to do it is just use these as reference point. Is price showing the stair-stepping pattern of an uptrend, a downtrend, lower highs, lower lows? Use them as a reference, but not as your ultimate trading decision. Ensure that you're using some sort of structure to look at because that's what price bounces off of, right? That happens over and over again. So use them as a reference. But if you're going to just take these, okay, prices pulled back and break out, ensure that you've actually tested a money management, trade management plan as well. Because without it, you're not going to have any success whatsoever. Remember that a lot of people use moving averages. A lot of people use a moving average system. At the same time, a lot of people fail at trading. Is there a coincidence that they're all using the same kind of thing or something's pretty similar? Probably not. but by understanding the moving averages and how they work, the nuances behind them, and that they're actually just plotting a calculation of previous price, you can use that to your advantage through trend and finding when price comes back into the moving average, it's coming into a balance point, and then look for some structure to trade against. That's when you're going to put the probability of success using moving averages into your pocket.